Breaking housing market collapse. That's the headline. Again. You've seen the thumbnails, burning houses, red arrows, bold fonts screaming 2008 all over again. But is it actually true? Or is this just another round of algorithm-fueled fear? A real estate apocalypse brought to you by YouTubers who've never held a mortgage. Here's the truth that no one's telling you. Affordability is at crisis levels. Wall Street landlords are pricing out families. And the dream of owning a home getting torched. But a crash? Like 2008? That's not the play. Let's break down what's actually happening and why America's housing problem is more disturbing than any crash headline you've ever seen. Point number one, affordability has flatlined. You don't need a crash when people already can't buy. In 2021, you locked a 3% mortgage. Today, try 7%. $375,000 at 3% is $1,600 a month. $420,000 at 7% comes out to over $2,800 a month. And that's before you factor in property taxes, up double digits in some states, homeowners insurance skyrocketing thanks to climate risk, maintenance, utilities, HOA fees. It's not just expensive, it's financially inaccessible. We're not headed for a crash, we're already in a freeze where people can't buy, won't sell, and the whole thing is locked in economic purgatory. Point number two, inventory is still pathetically low. You can't have a crash when there's nothing to crash into. Supply and demand 101. You need inventory to crash prices. The problem? We're still 35 to 40% below pre-pandemic inventory. Why? Because 85% of US homeowners have a mortgage rate under 4%. They're not moving, they're not listing, they're hanging on to golden handcuffs. So what does that mean? Buyers are frustrated. Sellers are frozen. Prices are artificially sticky. Even if demand craters, supply isn't showing up to balance the scales. So no, we don't get a crash. We get a slow, zombie-like shuffle sideways, while affordability keeps breaking down. Point number three, institutional investors are swallowing starter homes. You're not just competing with buyers, you're competing with BlackRock. This market isn't just families anymore, it's funds. Wall Street is buying homes like Pokemon cards. Single-family rentals, build-to-rent subdivisions, entire blocks in cash. Their play? Rent it out, raise their rent, and never sell. They don't flinch at rate hikes. They hedge them. And when these guys hold the inventory, homes don't come back on the market. So while you're waiting for a dip, they're turning the floor into a ceiling. This isn't your local market anymore, it's a chess match. And Blackstone brought the AI. Point number four, builders are playing it safe. Remember 2008? Builders sure do. In the latest crash, builders flooded the market and got burned. Now, they're cautious, strategic, and holding back. Housing starts are still below historical averages. Why? Lumber prices have surged. Labor shortages remain. Interest rates killed the margin. So instead of slashing prices, they're offering temporary rate buydowns, smaller square footage, incentives that look good on paper, but keep the comps high. They're not overbuilding, they're surviving, which means no oversupply flood, no glut of homes, and no crash domino from new construction. Point number five, Airbnb-geddon. Not quite. Everyone who thinks short-term vacation rentals will crash the market, think again. Yes, short-term rental revenue is down in oversaturated markets, and yes, some hosts are underwater on their mortgages. But is a flood of distressed Airbnb listings going to crash the market? Unlikely. Why? Most Airbnb properties are in vacation zones, not suburban starter neighborhoods. Many are owned free and clear. Others are being repurposed into long-term rentals. And let's be honest, the hosts who are suffering, they'll adjust before they panic sell. So while a few over-leveraged folks may get squeezed, the idea that Airbnb-geddon will crash the housing market, that's a fantasy mostly promoted by renters rooting for chaos. Point number six, the Fed isn't done screwing with the market. The Fed doesn't fix housing, it fights inflation. The Fed's job isn't to help you buy a house, it's to kill inflation, even if it wrecks the housing market in the process. Right now, inflation is sticky. Services inflation is still hot, which means the Fed is hesitant to cut rates. And if they don't cut, mortgage rates stay elevated. exploded. Buyer activity stays flatlined, affordability stays in the ICU. But if the Fed does cut aggressively, they'll likely trigger a buying surge, sending prices up again. Either way, the Fed's moves are adding whiplash to an already paralyzed market. It's not direction we're lacking, it's stability. Point number 7, lending standards are actually tight. This isn't 2007. Lenders are actually checking income now. People love to scream, it's 2008 again, but it's not. Today's borrowers go through full income documentation, verified assets, strong credit scoring. Subprime? Heavily regulated. Adjustable rates, far less common. And guess what? Delinquency rates are still historically low. Foreclosures, minimal. This isn't a debt bubble, it's a demand drought. So unless lending standards suddenly collapse, and there's zero indication they will, the comparison to 2008 is more YouTube fiction than economic reality. Point number 8, crashes don't trend, they snap. Crashes are sudden. This is a slow, painful bleed. Here's what an actual crash looks like. Unemployment spikes, loan defaults surge, panic listings flood the market. None of that is happening. Instead, we've got stubborn prices, sluggish sales, frozen inventory. This is stagnation, not a collapse. Yes, it's painful, and yes, it's frustrating, but it's not the kind of sharp correction that defines a true crash. This market isn't imploding, it's eroding, and that's a completely different beast. Point number 9, the real crisis. Homeownership is now luxury. Forget crashes, worry about the fact that we've priced out a generation. Let's stop asking if prices will crash and start asking who even has a shot at homeownership anymore. Because for millions of Americans, down payments are impossible, monthly costs are crushing, and institutional competition is unwinnable. The real estate ladder has turned into a gated fortress. And unless something changes, policy, wages, or rate structure, we're headed to a future where renting isn't a phase, it's permanent. Forget about 2008. This is the slow death of the American dream, and it won't make headlines until it's too late. So is a housing crash coming? Not exactly, but the market isn't healthy either. Affordability is shattered, inventory is locked, and the middle class being boxed out. This isn't a collapse, it's a quiet crisis. And the scariest part, it's happening slowly enough that most people won't see it until it's already done. If you want to stay informed, not just alarmed, smash that like button. Subscribe to American Money 101, where we cut through the headlines and expose the truth. Share this with someone still waiting for a 2008 repeat, because this time, the crash might be psychological, not statistical. Thank you for watching American Money 101. God bless.